News Talk 94.5 WPTI, 96.7 FM WTOB. You're listening to the Wealth Guardian Show with Doug Ray, helping you retire the job and keep the paycheck. In the studio this morning, you have Brice Payne and Garrett Ray. And this morning, we were talking about beliefs that fool retirement savers the most. Good morning, Brice.
Good morning, Garrett. Happy almost April Fool's Day.
Yeah, it's getting close. I guess we're a little early to the wagon, but, you know, we like to have fun and jokes around here.
Do you ever play a joke on Cindy? Or is that just not dangerous territory to go into?
Not her. I think the last April Fool's joke I played with was on my dad. And that didn't go too well either. So.
Yeah, I can see that. You got a better shot with Cindy.
Yeah. Yeah.
All right. Well, thank you, everybody, for joining us. Like Garrett said, we're going to be talking about beliefs that fool retirement savers the most, and we're going to cover that in the first and second segment here. Thanks for spending a little bit of your weekend morning with us. Spring here is fully upon us at this point. Garrett, let's go ahead and do our Wealth Guardian service salute. As we do every weekend, we want to take a moment and just say thank you to all the men and women in uniform and the first responders out there who do a job that's often a thankless job and an underappreciated job. And we just want to take a moment here and let you know that we at the Wealth Guardians appreciate you. We recognize and acknowledge the sacrifices you and your family make. And we just want to tip our hat to you. So thank you very much for that. And Garrett, thank you for your service as well.
Absolutely, Brice. Thank you.
And you came up with at the beginning of every show, we've been doing this for a while now, we ask questions of ourselves just so you can have a better sense of who we are here at the Wealth Guardians, what makes us tick, that we're real human beings just like you. And Garrett came up with the question for ourselves this morning. And what is it, Garrett?
Yeah, so we're going to ask ourselves, what's the most significant weather event you've ever been a part of? And I'll go first. I will always remember this. I was a little guy at the time, but Hurricane Hugo, when it hit the Charlotte area in 1989, that is where little me and my parents resided at the time. And I remember the storm coming in the morning, early morning, and I remember getting up and super loud noise, walking to the back, like sliding glass door of our backyard. And I remember seeing the favorite tree that I would climb in bent all the way over, almost like a U shape down to the ground. And I remember thinking, that's not normal. My mom saw that I was close to the glass door and she immediately got me out of the way. But I'll never forget. It was the first time I remember being little and seeing wind like that.
Yeah, that was a big storm.
It was wild.
I remember that one. Absolutely. Well, I don't know if this counts as weather related, but Joe Strummer does have an album called Earthquake Weather. And so the most significant weather I was ever in was I was living out in California at the time of the, was it 89 or 90 earthquake that leveled San Francisco again and stopped stopped the World Series.
I think that was like 92, 93.
No, it wasn't then because I was already out of there by then. So it was either 89 or 90 in my sophomore or junior year. So that was my most significant. Now I was a little bit further south, so it wasn't as hitting us as hard as it was up north a little bit more. But I've been through many earthquakes at that point out there, living out there for 3 years, and we could tell that one was bigger than the normal one.
Absolutely.
Yeah.
Absolutely.
All right. So that's it. Good question. Good question. I like it. All right. So let's go ahead and dive into our topic here. April Fool's beliefs that fool retirement savers the most. And so April Fool's Day, it's all about jokes and pranks. But when it comes to retirement planning, getting fooled can often cost you real money. So today we're uncovering the beliefs that fool retirees and pre-retirees into making bad financial moves. And the first one we want to talk about is guaranteed, and I'm doing the air quotes there, guaranteed high returns are easily attained. Garrett, in our field of work, there is one word that we have to tread very lightly around if you use it all, and that's the word guaranteed.
Yeah, if it's guaranteed, it's likely not going to be that high of a return. It's kind of easy to perhaps be fooled into that when you listen to too many talking heads. The reality is, in order to get some of the higher growth, higher return performance, you have to have a pretty strong stomach. You have to be willing to stick out a decent amount of risk exposure. And just understand that for the year, 2, maybe 3 that you're getting those high rates of return, 9, 10, 11, 12% annualized, that those types of investments typically have high volatility.
Right.
And we know that the market can basically throw up on itself about on average once every 7 years. And you can be down 20, 30, even cut in half like we were back in 2008, 2009. So the idea is that, you need to make sure that you are well diversified. You have some growth engine on your portfolio. But to say that guaranteed high returns are easily attained, that's just not true.
You can, you might say, well, my neighbor told me about, he got into, this or that when it was low. And yeah, but how often is he bragging about the ones that he missed?
Sure.
There's a lot of hit and miss out there. Now, if you are comfortable with risk and you're okay, and you and your advisor have said, hey, it's not a big deal if you lose 30 or 40% of your portfolio, and that's what makes you happy, by all means. But you and your advisor should at least know what not the upside potential of your portfolio is, but what the downside is as well. And what difference does that make if you did actually achieve a 40% loss or even a 30% loss in your portfolio? What does that mean to what you're ultimately saving for, in most cases, retirement? If it doesn't affect retirement, maybe you've got a huge pension and some good Social Security, and that combined that is less than what or more than what your spending is, then great. If you lost 30 or 40% of your portfolio, probably is not doesn't change your retirement picture. But if it does, you at least want to be aware of that ahead of time and balance your risk with your growth expectations.
Yeah, absolutely. And basically just said, don't put all your eggs in that one basket.
Right.
If you have other means of income, then sure, maybe you can get a little bit more aggressive on your investment side of your portfolio because you have other means of income.
But let's at least work that out with your advisor to know ahead of time. All right.
Absolutely.
If you're just tuning in, you're listening to the Wealth Guardians show with Doug Ray, and in the studio this morning, it's Brice, Payne, and Garrett Ray. And we're talking about April Fools and beliefs that fool retirement savers the most. So we're going to keep talking about this in the second segment as well. But the next one, Garrett, one of our favorite topics, Social Security. And the Social Security myth is that you better claim it ASAP before it runs out. And there's been a lot of talk about Social Security in just the last few weeks alone. So let's talk about this one.
Yeah, we definitely run into folks who are itching to file ASAP. As soon as they turn 62, they're concerned that, is Social Security going to remain solvent? Mm-hmm. It just gives me better peace of mind to just go ahead and turn that income on. I would caution you to say that is, it sounds at least like that would be a highly emotional decision making there. Have we done some analysis on what your benefit compared to your partner or your spouse's benefit is? Oftentimes we see that one person or the other has a very significant difference in their benefit compared to the other.
Right.
So does it make sense if we're going to file early, maybe that the person with the lower benefit goes ahead and turns theirs on, but the higher earner with the higher benefit perhaps strategically waits so that they can maximize those delayed credits on that already higher benefit. And then if they did happen to predecease the lower earning spouse, then that's a level of protection for the lower earning spouse because he or she gets to step into that higher benefit upon death. So there's some different strategies we can talk about that isn't just a blanket, I'm going to file as soon as I possibly can.
Exactly right. Yeah, none of our strategies are let's get it before it's gone type of strategy. No, so if you're out there, if you're wondering, well, why are these guys talking so much about Social Security? Well, let's think about it for a second. For most people out there, when I say most, I'm going to say 90% of people out there, Social Security is their main form of income in retirement.
That's right.
And if you are in a different situation where you've got a large pension or maybe rental income, passive income in retirement, that puts you on about the 10% side there, not the 90%. So, and we are certified with the National Social Security Association here at the Wealth Guardians. So we have gone through the training and understanding of how Social Security works, how the different filing strategies work. And you really want to make sure that when you file, you're filing it not on fear. And there are a lot of people who tend to say, well, I just want to get it before my money's gone or before it disappears. I've said this before. I'll say it many times. If they make changes to Social Security, meaning Congress is actually going to put their individual stamp on a bill, they're going to make those changes to somebody who is maybe 40 years old, 45 years old, and younger. They're not going to likely make it changes to somebody who's in their 50s or let alone their 60s because they want to keep their job, right? Sure. And they're probably going to come into some opposition if they put their name on a bill to cut somebody's Social Security right when they were about to receive it. So they want to keep their job. So it's probably not going to happen like that. But there will have to be changes made at some point down the road on Social Security. And let's not act out of fear. Let's act out of
From a planning perspective.
Yeah, from a planning perspective. Let's use tactics here. All right. Well, we're going to have to cut to a break here, and then we'll come back and tackle more of these subjects. But let's go ahead and just do a quick shout out to ourselves here. If that topic about Social Security and taxes that we've always talked about here and returns on your investments, if that's something that you kind of want to sit down with a professional and make sure you're doing it all right, or see if a professional has some different ideas for you about what you could do better to enhance your retirement picture, then I'm going to invite you to give us a call, 336-391-3409, or visit us on our website, thewealthguardians.com, to go through our planning process with us. There is no cost. There is no obligation. And when all is said and done, if you decide, hey, I really like these guys, I want to go ahead and implement the plan that they put together for me, then great. We can go into the implementation process. But if you decide, I'm going to keep looking around, or I think I'm okay where I'm at, that's great. At least you learned something from the whole process and it didn't cost you anything. So I think it's a win-win for you either way. We would encourage you, if you're approaching retirement, to sit down with a holistic financial planner who's a fiduciary and just make sure that you are operating on all cylinders. All right, well, let's go ahead and get to the break here. And what happens before we get to the break? We hit one of us, and today it's me hitting Garrett with a trivia question. And this caught my eye over the weekend, Garrett. And so I thought, Garrett's an engineer. He'll like this question. So here we go. On March 31st, 1889, this structure was completed that became the tallest man-made structure to date at 1,083 feet, beating the until then tallest structure at 555 feet by a whopping 528 feet. So it almost doubled the previous structure's height. What was this new structure, and what structure did it beat? Now, keep in mind, Garrett's a civil engineer, so I know he knows this. All right, we'll stick around for the answer to that trivia question on the other side of this break. This is Brice Payne with me is Garrett Ray. The show is the Wealth Guardians, helping you retire the job and keep the paycheck. And this is News Talk 94.5 WPTI. And this is 96.7 FM WTOB. News Talk 94.5 WPTI. 96.7 FM WTOB. Welcome back to the Wealth Guardians Show, where we help you retire the job and keep the paycheck. I'm Brice Payne in the Wealth Guardians studio, along with Garrett Ray. And in this second segment today, we're going to continue our discussion on beliefs that full retirement savers the most, now that we are approaching everyone's favorite day of the year, April Fool's Day. Now, before we answer the trivia question that left you hanging at the end of our last segment, I want to ask you this. Are you planning to retire? Probably so. Have you ever met with a retirement income certified professional who's also a fiduciary? Well, hopefully so. But if not, then I want to invite you to take us up on a complimentary review of your current situation. So as certified retirement planning specialists, we're going to put together a customized written plan with strategies for portfolio allocation, income distribution, Social Security filing, tax efficiency, and even the additional benefit of often reducing both the risk and fees of your current plan. So if you put aside at least $400,000 and you want to take us up on this no cost and no obligation review, call us at 336-391-3409 or go to thewealthguardians.com. That's thewealthguardians.com to learn more. Let us show you in black and white how to retire the job and keep the paycheck. All right, Garrett, and to everybody else out there, the trivia question. Here we go. Let's state it again here and see how we, if we did or didn't stump Garrett. I'm pretty sure we didn't. Garrett, on March 31st, 1889, this structure was completed that became the tallest man-made structure to date at 1,083 feet, beating the until then tallest structure at 555 feet by 528 feet, almost doubling the height of the previous one. What was this new structure, and what structure did it beat? 1889.
I have a guess. All right. So I believe the structure we're talking about, which was the new record setter at the time, is the Eiffel Tower. And I believe that it beat out the London clock tower known as Big Ben. I think that's it. That's wrong.
That's not quite right. It was the Washington Monument.
The Washington Monument.
The Washington Monument was the next one. So you got half of it. That's pretty darn good. Yeah, that's nice. I like it. I figured you would know that as the Eiffel Tower. I didn't realize it was almost twice as tall. Is what had existed previously. And I had no idea before learning that the Washington Monument ever held the highest. It's actually, I didn't either. It's taller than the Giza Pyramid. I didn't know that.
I didn't know that either.
All right. There's a couple of cathedrals in there between the Giza and the
the Cathedral of Notre Dame.
Yeah, exactly.
Yeah.
All right, well, let's go ahead and continue here our discussion on beliefs that fool retirement savers the most. And the next one we want to talk about here is the set it and forget it retirement plan, buy and hold strategy or strategic management of your portfolio. Talk about that, Garrett.
Yeah. So, for most retirees out there, unless you just have an incredibly large portfolio where you can absorb a potential 20, 30, 40, 50% drop in the market and still be able to take the necessary distributions from that portfolio, even in those down years. The set it, forget it, and I love him when it comes to his strategies around, debt management, but Dave Ramsey really does this to a lot of folks. Just buy a good quality market index fund, and that's your strategy. Yeah, Dave's right that's a pretty decent growth mechanism. But when you enter retirement and a good portion of your income depends on distributions from those market indexes, and what happens if that market index just so happens to be down 40% a year or two after you retire? Most people are not going to be in, I'll say, a rosy situation at that point. Unless your portfolio has some decent stop loss controls, that to me is not a plan. That is I'm sending up a prayer. That is your plan.
That's a good way of looking at it.
Now, that can work out great for you if you just so happen to enter a market cycle where the market is going up and we're on a strong bull run. But that window of that first 5 to 10 years of retirement where you're in your mid 60s or so, and nobody comes to Brice and I or Doug and I and says, I only want to be retired for 5 or 10 years. Most people, when they retire in their mid 60s, they're hoping to make it until at least their mid 80s, possibly their mid 90s. If your portfolio gets cut in half in those first couple of years, maybe you haven't filed for Social Security, maybe you have, but for most people, Social Security isn't quite enough. You are dependent on that portfolio for distributions, and it just got cut in half. And it has the last 20 more years. No, thank you. That is not a plan.
Yeah, I encourage people, if the saving for retirement, the wealth accumulation phase of life lasts you 40 years or so, you tend to ask yourself the question, whether you know it or not, how much risk can I afford to take? And I really encourage people to, when they enter the retirement stage of life or the distribution phase of life, no more the accumulation phase of life, to change that question to how much risk do I have to take?
Exactly.
And a lot of times the risk you have to take is not as great as you think it is. And so why subject yourself to a potential 30 or 40% loss if you don't need to? If you can dial back that risk and only lose 10% when the market is losing 20 or 30%, maybe that's still enough growth for you with that kind of strategy that you're still going to get by in retirement. And that's what I encourage people to ask that question. Here's the analogy that I use. You're trying to get to up as high as you can on this mountain peak, and there's 2 roads. One of them is a really pothole-ridden road. It's a very bumpy ride. You got to take a 4-wheeler up it. It's going to be a bumpy ride, but that road will take you up pretty high up the mountain. But there's another road which is paved and much smoother. It's not going to get you as high up the mountain, but will it get you high up enough up the mountain to see that view that you want to see?
Right.
Well, if it is, you don't need to go higher than that, and it was a smoother ride. Ask yourself, would I rather be on this road than the other one? And that's the difference between tactical management and strategic management. The buy and hold strategic management is just get yourself a portfolio and sit in that regardless of what the market's doing. Hey, over a 30, 40-year period, that strategy is probably going to pay off for you more than another one will, but it's going to be a really bumpy ride. Ask yourself, do I still want to, is my back still good enough to sit on that that seat while we're going all through all these potholes? All right. If you're just tuning in, you're listening to the Wealth Guardians Show with Doug Ray. And in the studio, it's Brice and Garrett, as it is a lot of the mornings here. And thank you for joining us. And we're continuing our conversation on beliefs that fool retirement savers the most. Let's go to this next one, Garrett. The 4% rule makes retirement planning easy. Well, I don't know that I've ever called retirement planning easy, but share with us what this 4% rule is.
Yes. So Brice, this is a pretty popular rule of thumb out there. And honestly, it's not a bad starting point, but it's not a be all end all. What they're talking about in the 4% rule is once you do retire, taking a distribution per year of around 4% of your portfolio's value should be enough for retirement. Now, in some cases, that is true. But there are studies out there to show that in some cases you may have to take more. In some cases, you don't have to take nearly as much. A rule of thumb like that knows nothing of your particular situation.
Right.
If you sit down with a planning session with us, we're going to go through a whole cash flow of the household. What are your income streams? What are your expenses? And oftentimes the expenses piece of it is the hardest thing to nail down.
Right.
But when you go through that pain, and it can be painful sometimes, but when what you get out the other side is a clear cash flow of the household, and it will determine what drawdown is best for you. Now, the other thing that's I don't like about this rule of thumb, so to speak, is that early in retirement, people tend to spend more, and it makes sense. They're young enough where they are relatively healthy. They want to travel more. They've got probably grandkids to go see. Family members are still alive, so they're traveling to go see them, brothers, sisters, nieces, nephews. But as we age, our spending patterns tend to slow down. Now, do you have to take a higher distribution in your early retirement years and then maybe dwindle that distribution down over time? Perhaps. But it needs to certainly be adjusted. And just to say, I'm going to go with a blanket 4% per year, you could have not enough income when you want it, or you could have too much income at certain stages in your life.
Yeah, no, it's all good. And I would say that taking it on its face value, the 4% rule makes about as much sense as taking on its face value. You have to have $1 million in order to retire.
Exactly.
So it's not taking into account any specifics of yours or anybody else's situation.
At best, it's a decent starting point.
Exactly. Right. If that rule stumped you or anything else that we're talking about, and you think, well, I really probably should sit down with at least a holistic financial planner who's retirement specialist, and might as well be the Wealth Guardians. And I encourage you to give us a call and just see if we can throw out any ideas there that might enhance your overall retirement picture. Because, there's a lot of calculations that go into retirement planning, and you want to make sure that you've got them all right. Social Security filing, pension filing, whether or not you're going to annuitize your pension. There's just still, what accounts do I draw down from in certain years? Should I do IRA to Roth conversions? There is so much that goes into all of that. And I'd encourage you to give us a call at 336-391-3409. You go through our planning process with us. There is no cost or obligation other than for you to spend money on your gas to get to our office. Other than that, you're going to walk away having learned a little bit, if not a lot, about what financial planning and retirement planning is about. And maybe you'll say, hey, gosh, these guys really know what they're talking about. And there was a lot of things that I hadn't planned on in my retirement that they showed me. And I think I do actually want to go ahead and become a client and implement the plan that they put together. Then great. If you walk away and say, yeah, I'm going to keep thinking about it, but thanks, at least you learned something, right? And there's, like I say, no cost or obligation to you. Let's jump in this last one here real quick, Garrett. Chasing and obsessing over high dividend stocks.
Yeah, so dividend stocks are pretty popular for retirees. Now, the reason you would invest in that is you get, in theory, the best of both worlds. You get a high-quality company stock that is the actual asset, or the stock price is appreciating, so you're growing your account value. And every quarter, typically, you're getting paid a dividend that you can turn into an income cash stream. It is pretty easy for folks when they are in the retirement years to focus on, hey, what is that dividend I'm getting paid? And man, it'd be nice if it was a lot higher. That is true. However, just know that a lot of stocks out there that pay an extraordinarily high dividend yield are typically not the most healthy companies. They will pay a high dividend just to simply attract investors to keep their stock afloat. The other thing is that, a company has to declare its dividend typically at least once per year. And they're committed to, at least on paper, paying that dividend for the next year. Now, they can suspend it at any time. But two, if the stock price goes down significantly in that year, they're still obligated, at least on paper, to pay out that dividend. And they may not have the cash sufficient to do it if you're in a poor quality company. So just understand that high dividend stocks, they are attractive just because on paper they look nice with what income stream you could get, but make sure you know what you're investing in and that company has the cash flow and the cash balance to sustain those dividend payments.
Exactly. Well said, Garrett. Well, that's going to wrap it up for this weekend. Thank you very much for spending some of your weekend morning with us, and we hope to see you here next weekend. We hope the rest of your weekend this weekend and next weekend, for that matter, is everything that you want it to be. We want to help you, as always, retire the job and keep the paycheck. And remember, sound financial plans do not create themselves. This is News Talk 94.5 WPTI. This is 96.7 FM WTOB.
Hi, it's Garrett Ray with the Wealth Guardians. Thanks so much for listening to the show. Make sure to check out our weekly series, The Vault, on YouTube. Find our channel, The Wealth Guardians, where we talk about all things retirement planning and cover new topics each week, such as Social Security, tax planning in retirement, and our thoughts on investment best practices, and much more. New episodes air Thursdays at 2 p.m. Make sure to subscribe to the channel so you can get notifications when we release new episodes. We're here to help you retire the job and keep that paycheck. We'll talk soon.